continue to kind of a rolling panel here. I know Java's testimony today will be very short, so we're going to let him go.
Thanks, Mr. Chairman, Vice Chairman. I think there was some questions about. I'm sorry. Yeah, sorry. Thank you, Mr. Chairman, Mr. Vice Chairman. Thanks. You know you're the VIP when you get the folding chair in the corner, so I feel really blessed. Good friend Lester, we're okay. Thank you, Mr. Chairman. I am with Checking to Cash, and thank you, madam. I was going to talk a little bit about what other states are doing to address this same problem. Certainly, California is the largest state, but we don't live in a bubble as far as this is not an issue that's not out there. And what I'd say very quickly, Mr. Chairman, is there are a dozen or so states that already have some coverage for this bubble that we keep talking about. What do we do between existing products in the state, the 500 to the 300 to the 2,500, and certainly the pilot program is a great idea. It's just not there to cover the volume of loans and the amount of customers that we have, and we encourage the pilot programs, and it's great.
What are some states that are working?
What we've got is, we've got some states, I think Kansas, Missouri, Wisconsin, Virginia, Ohio. You're looking at they have installment products that are working for the customer and are working for the companies. But what we've really seen is in the last year, Tennessee just passed a new piece of legislation. They entitled it the Flex Loan, and that it was a flexible product. And for your references, it was passed by both a supermajority in the House and the Senate, Republicans and Democrats alike, not opposed by the Department or the Attorney General, and not one single anti-business advocacy group opposed it, and that same legislation is now pending in 12 other states.
That's right. Correct me if I'm wrong. Georgia, the neighboring state to Tennessee, outlawed traditional payday lending?
Yes and no. Georgia allows for an installment product that allows ancillary products to be sold. We have stores in Georgia. Often those costs are much higher than a traditional payday loan, and title lending is legal in Georgia. So Georgia does not have a 2-week deferred deposit product, but they do have short-term credit available in Georgia.
I have been told that along the Georgia-Tennessee border, you get quite a bit of traffic from people from Georgia going to Tennessee to get loans.
As far as payday goes, our 2 largest stores in the country are located on the Chattanooga state line, right between Tennessee and Georgia and Chattanooga, and then in Phoenix, Alabama, which is right on the border of Georgia. As far as payday goes, we offer other products, but that particular product, those are our 2 biggest stores, yes.
A good reminder to, I think, all of us that we do not operate in a bubble nor a vacuum with these.
But there are other chairmen and other committees that are dealing with this very same issue, and I think it's interesting that lots of them are going in the same direction. A lot of the concepts that you've already heard today are things that are being discussed in capitals all over the country. So I think you're headed in the right direction, and we really appreciate the interest.
One more question for you, and I appreciate your brevity. Mr. Covert, what do you think of the Colorado law that passed in 2010? Do you operate stores in that state?
We do. We do operate. And I think the Colorado law is very interesting. I think that with the few exceptions of some staff interpretation quotes, it is a product that does work. What I find interesting, Mr. Chairman, I think it's important, is some of the anti-business advocacy groups supported the Colorado model until companies found a way to be profitable and survive there. And they've now decided that they're opposed to the Colorado model. So they have switched. And I think that's the point is kind of whatever model we come up with and agree to, we're not going to get the support of certain anti-business groups just because if it allows us to survive, it's not going to be a good model. And we just want to do whatever is the will of the General Assembly, sir. And Colorado model with some tweaks does possibly work.
I appreciate your time today. Thank you.
Thank you.
Before we move on to Ms. Farron, I had one question. Excuse my notes, got a little distracted here. We'll ask Ms. Garcia and Mr. Grinaldi, what would you think of a real-time tracking database that the DBO ran to eliminate some of what we consider consumer abuse of these products?
The concept of a real-time tracking, and it depends on, I guess, Mr. Chairman, what area of lending are we looking at?
Say more storefront, payday.
So payday, it looks like the legislature has originally, if we go back to when the law was initially enacted in 1997, and then it was changed by Senator Parada, and it went into effect in 2005. And since then, the legislature has looked at it multiple times, and they've decided that a database structure would not necessarily be appropriate. I think it comes back to there's a reason why there may be people that are using the product that we've heard earlier that may have used it more frequently than they should have, and they'd be better served to buy a product above $500 that would be a term loan in multiple installments. I mean, if we look at it, they're cobbling together multiple loans.
Yeah.
I've used this analogy before. If you've got a 25-gallon gas tank and you're forced to go to 2 different gas stations because you can't be sold 25 gallons of gas at one, that's causing the problem. So, Mr. Chairman, I think that we can solve that problem by fixing the problem of over $500 to $2,500 and open up that marketplace to more innovation and more loans.
Well, I think Mr. Vaca has hit the nail on the head when he talked about his average amount was around $1,000. I've gotten a lot of, I won't say scientific evidence on that, but anecdotal evidence that it seems to be a sweet spot closer to $1,000. I will tell you in our very unscientific survey that we did with my district in an email that was hundreds of responses in a matter of days over the weekend, and I'm sure we'll get more in, and we're going to try to share that with my colleagues, and we'll help them do similar in their districts. One of the biggest complaints was a very similar, the amount was not a good fit for their needs, and they had to cobble together multiple loans. That led to I think, some will call it debt trap or other situation where they had multiple loans out, could not pay those loans, and they got into a spiral. They're taking multiple loans now at multiple locations. And then unfortunately for some, that became a stopgap monthly to make up for bills and other loss of income, maybe from a lost job, medical situation. And instead of being a stopgap for a one-time emergency, it became really an income that they needed to supplement their traditional sources of income on a monthly basis. So very interesting. Ms. Garcia, would you like to add anything to that?
Sure. I just wanted to mention that, real-time tracker, if we were to limit a customer to, say, one payday loan, if they need additional income, since we're talking about payday specifically, they're going to find it somewhere else. Yeah. So they're either going to go to the unregulated online internet. We don't regulate the number of times somebody swipes their credit card. So it's one of those things where we really just have to carefully weigh what's best for the consumers as well.
And none of you that are loan providers on the panel, I mean, it's impossible for any client that isn't committing fraud to come in and get multiple loans out without having to renew a loan. You can't get multiple loans out at the same time that are...
That would be illegal under California law. And if we look back to 1997, so it's almost been 20 years since the deferred deposit transaction law was enacted, and I think inflation, that $300 maximum, which includes the fee, remained the same. However, all the costs associated with doing all the things we do in order to give out the loan, those costs have increased. And I think if you adjust for inflation, that $300 is now like $447. And yet we haven't increased that over the years. So that's why they're seeking out, Mr. Chairman, these loans on the internet or where else they're going to get these.
To either you or Mr. Covert, if you'd like to briefly, before I turn over to any of my colleagues, I'd like to ask before I'd ask you to step down, and we'll let a few more step up. What do you think good underwriting looks like? I know Mr. Gonalti, you already kind of presented that, but to Ms. Garcia, Mr. Covert, do you have any thoughts on what good underwriting looks like?
Well, look, we want to make good loans. Yeah. We're a for-profit entity, and we want to be repaid. Yeah. So, depending upon the loan, depending upon the law, the underwriting is a little bit different, but we certainly are in favor of underwriting. But, Mr. Chairman, what we're not in favor of is having the same underwriting for, say, a $1,000 proposal that you've proposed that you would have for a $200,000 loan, which is what we hear out of Washington and what we hear out of some of the other groups. We do believe in underwriting, absolutely, 100%.
We agree one size does not fit all. So with that, I'll let Mrs. Garcia and Mr. Covert, thank you for your testimony today. I appreciate it. And before we go to Mrs. Farron, we will call up Mr. Levy and Ms. Kazantis. They'd like to also join us. Ms. Farron, thank you for being patient. The floor is yours.
Thank you, Mr. Chairman, committee members. My name is Lee Farron. I'm the directing attorney of the Consumer Law Project and Operation Veterans Reentry at the Public Law Center in Orange County, California. We are a nonprofit legal services provider providing free civil legal services to low-income residents of Orange County. I'm here to provide a slightly different perspective, I think, than what you've heard so far. I'm going to tell you what the perspective of my clients are. that I work with every day. Our work in the consumer unit is particularly relevant. We work
Just say
with
briefly, who are your clients?
low-income residents of Orange County.
Thank
So I work in the consumer unit, so they're mostly facing issues like bankruptcy, debt collection, student loans, payday loans, installment loans, that type of thing. First, I want to give you just a couple examples of loans that we've seen recently. We saw a $5,125 loan, 115% APR. It's a 7-year loan, so it's a finance charge of $37,000. So they would pay $42,000 on a $5,000.
What was the original? 5,000?
$5,125 was the original loan amount. A $2,525 loan, 129% APR, a 4-year loan, a finance charge of $11,500, so a total of $14,000 on a $2,500 loan. And finally, a $2,501 loan, 183% APR, a 2-year loan, so a finance charge of $7,400. The interesting thing, I think, particularly the last two loans, they're just barely over the unregulated limit of $2,500. We've actually had a number of clients come to us to tell us that they were looking for loans of $1,000 or $1,500, but the lenders pushed them into the $2,501 loan, specifically so that they could get into the unregulated area, we can only assume. The other thing we've seen, the purpose of the loans, generally speaking, our clients, they're not taking the loans out to finance sudden or temporary emergencies. They're being made to people who are on fixed income, like Social Security, veterans benefits, for regular monthly expenses like medical expenses, rent, food. They're making the lenders are making these loans to people who need additional income to solve a long-term problem rather than a loan to address a short-term problem. They're also, as I think we've all heard today, they're a lot of times the loans are made to people who have multiple loans outstanding, ranging from traditional payday loans of $300 or less up to loans for $12,500. Most of our clients have at least 3 or 4 of these loans. We do see that loans to finance emergencies might be useful, so long as everyone else has pretty much said so far, there's a reasonable APR, there's borrowers who have reliable income sources, particularly income that may actually change, because a lot of our clients are on fixed income. It's not going to change next month. It's going to be the same month after month after month, unless they can do something about it. With no underwriting standards, the loans are being made despite borrowers' income being too low and unlikely to change, meaning they'll never be able to afford the added monthly expense of the loan payments. The automated payment requirement of most of the loans also means that once the loan is taken out and payments are being made, payments on the loan actually prevent the borrower from paying for their living expenses like prescriptions and food, etc. Almost every client who's come into our office with a complaint about a payday or installment loan has ended up filing for bankruptcy. The payments are just too much for our fixed income clients to handle. A lot of loans we see are made online or over the phone. A lot of times the disclosures are not viewed till after the loan is made, so they don't actually, and explaining this over online or over the phone is not something that's easily done, especially to some of our clients who are less educated. And most of the complaints that we receive about collection practices come from payday lenders, installment lenders, making illegal threats about arrests, about coming down to their workplace, seizing funds when they cannot. This worsens the borrower's experience, but are also a violation of Fair Debt Collections Practices laws. A lot of these loans prey on desperate people. The lenders pressure borrowers into believing they can pay the loan off and that they can do it quickly. The borrowers get a false sense of hope or misunderstanding of the loan terms based on the lender's representations. One of our more sympathetic clients, she took out some of the worst installment loans, some of the ones I mentioned earlier. She was well educated. She's a paralegal in her prior career. She now has a disability. Looking back, she now understands she was wrong to believe the lender who pressured her and made it so easy to get her hands on the cash. The loans were not the solution for her. Instead, she will be filing bankruptcy shortly. If they had not been available, she would have done what she is doing now, which is we are helping her apply for an increase in her VA benefits to try to get her additional income every month. And she's had to rely on her friends and family when she gets in a jam. But they're slightly more favorable on their loan terms. She's not happy about it. She's not happy about her experience. The loans did not address her existing problem. And now she has an additional large amount of debt and an upcoming bankruptcy on her record, thanks to the loans. Okay, perfect. While there may be a place, as I've said, for small dollar, short and long-term loans, More regulation needs to be in place to ensure they do not do more harm than good. Currently, from what we've seen, the loans harm our low-income clients, particularly those on fixed income, who are drawn in by the representations and the promises. They soon find out it's just another debt that they cannot repay, and another creditor that calls and harasses them for payment. We're encouraged by the attention being paid to this issue by the Consumer Financial Protection Bureau, the California Attorney General, and when the time comes, whether it's now or whenever it is for California to look at its own laws regulating the loans, we hope the legislators will recognize the importance of common sense safeguards, as everyone has discussed today, to ensure responsible lending. Thank you.
So my name is actually Noemi Guzman. I'm filling in for Kira Kazantzis.
Don't feel so bad. You can tell her I said her name perfectly.
Okay, I will. So good afternoon. My name is Noemi Guzman. I'm a paralegal for the Public Interest Law Firm, which is one of the programs of the Law Foundation of Silicon Valley. We're a nonprofit law office that has been working on advocating for better protection to our community members against payday lenders, along with other nonprofit organizations, unions, direct service, and legal service providers. CAP, or Coalition Against Payday Predators, was created for that exact reason. CAP has been working on its advocacy efforts for a few years to regulate high-cost payday lending outlets at the local level. We have made great progress passing local ordinances in the following jurisdictions: Santa Clara County, San Jose, Gilroy, Sunnyvale, Morgan Hill, and most recently the city of Campbell. Numerous cities across San Mateo County and around the state have also adopted such ordinances. We believe these local ordinances are an important step toward protecting vulnerable neighborhoods against the overproliferation of predatory lenders. However, we need the state legislature to advance real consumer protections. We support a 36% interest rate cap and ability to pay requirements across the board and other measures to prevent high-cost debt traps. We at the Law Foundation and at CAP see the impact that high-cost loans have on consumers struggling with high-cost debt. It doesn't improve their situation. It hurts them and their families, putting them in a worse situation. And that is why we are here to advocate for state-level reforms to better protect consumers. We're optimistic about the federal CFPB rules, and we urge your leadership in reforming payday, car title, and installment loans in California. Thank you.
To conclude with our panel here, we have two more speakers, but just for the effort to have the most robust question and answer period, we'll ask Mr. Schulman to come back up if he's still here. I'm sorry, Mr. Shaw, I'm sorry. Shaw, Mr. Shaw, I'm sorry, I said Shulman. Mr. Levy.
Thank you. My name's Arthur Levy. I'm a consumer attorney, and I have been lead counsel in several class action lawsuits against lenders, most notably Chase, Bank of America, Loan Mart, Wilshire, and also Cash Call. I'm also of counsel to Housing and Economic Rights Advocates, which is a nonprofit and legal advocacy organization based in Oakland. For the past 7.5 years, I've been the lead attorney in the O'Donovan class action, which is a class action against Cash Call in the Federal District Court in San Francisco. In that case, we've challenged Cash Call's 96% and 135% $2,600 installment loan products. And because those loans are over $2,500, they're not subject to any fixed usury limit in the California Finance Lenders Law. So instead, we've challenged those loans under the provision of the Lenders Law, which applies California's general unconscionability law to all loans under the Lenders Law, including those over $2,500. Now, we conducted extensive discovery in the O'Donovan case into Cash Call's underwriting, marketing, advertising, and collection processes. And in the course of that, we learned about Cash Call's lending model. And that discovery is now a matter of public record. So I'd like to summarize it for you so you can better understand the lending model that Cash Call has used. And I believe other lenders who charge very high interest rates on consumer installment loans, such as Check and Go, Rise Lending, Cash Central, and Loan Me, also use the same or a very similar model. The bottom line is that Cash Call does not make loans by applying a traditional ability to repay determination. Instead, it lends money to people that Cash Call knows aren't going to be able to repay. Cash Call sets its interest rates using a model that forecasts 1/3 to 40%. That 1/3 to 40% of the borrowers will eventually default on their loans, and that Cash Call is going to have to write those loans off and treat them as bad debts. Sounds crazy? Well, it's not. Strategically lending to people who can't repay is the bedrock of all irresponsible subprime lending. I emphasize irresponsible because there are responsible lenders, some of whom we've heard from today, who provide access to credit based on making traditional ability to pay determinations.
About 1 minute, Mike.
Okay. How does Cash Call do this? They need the very high interest rates in order to cover these very large loan losses. If these lenders use traditional ability to repay standards, their pool of potential loan applicants would shrink, and they'd no longer be able to maintain the loan volumes they need to support their profitability. So they charge extremely high interest rates, up to 200% or more, to cover these massive loan defaults that are built into their lending model. These lenders bank on some people being able to repay their loans, but as Mr. Leonard mentioned, even those who default, because the interest rates are so high, are going to end up covering the loan and making a profit for the lender in a significant number of instances. But those borrowers who default are subject to repeated robocalling, threats, adverse credit reporting, and other hardball methods, as well as small claims lawsuits. So, in closing, interest rate limits promote healthy, responsive access to credit and credit opportunities by creating a direct financial incentive on the part of the lender to underwrite by making an ability to repay determination. Having no interest rate limits opens the field to lending practices like Cash Call uses to lend irresponsibly to 1/3 to 40% of the borrowers who are unable to pay. Eliminating interest rates creates the market conditions that enables Cash Call and its peers to strategically lend to people who are unable to pay, reaping profits for themselves and misery for their borrowers. Thank you.
Thank you. Our last panelist for this panel, before we go to number 6, will be Mr. Furstenberger. That being said, if Ms. Farron is still here, she's welcome to join the panel for the Q&A right now.
Thank you, Mr. Chairman. My name is Lester Furstenberger. I'm Senior Vice President, Regulatory Affairs, Government Affairs for Dollar Financial, DFG Global.
I'm sorry, Mr. Furstenberger. Can you just bring the mic a little bit? Can you make sure that mic is still...
Is that better?
Yeah.
We operate in 11 countries. We have approximately 100 stores in California. I could talk about any number of products, but what I wanted to take my 5 minutes with is a new idea for a product from the $500 to $2,500 space. I've passed out to the committee members just a product overview of that. The idea for this product is an installment loan that allows consumers to earn credit. So the idea is, and I'll speak conceptually about it and then allow people to ask questions if they're unclear. The interest rate will start, and this is not written in stone, it's just an idea for an example, 150%. $1,000 at 150%, and there's an amortization table in the back for you if you'd like to look at it. They pay 3 payments or 90 days on time. We'll reduce that interest rate 50 points down to 100%. They pay it another 90 days on time. You reduce the interest rate another 50% down to 50%. They pay 3 more payments on time, and we'll take them down to 35% under the magical 36%, which Again, one size does not fit all. So this is a product, though, that allows consumers to earn their way to credit appropriately. For the ones that don't perform and you do have the higher credit losses, that concept has to be taken into account for for-profit corporations that are trying to make profit.
Would their interest rate go up then if they missed a payment?
No. So under the model that we're going to test, and we're going to try this at the $2,501 because currently it's not enabled in the legislation now, just so that we have data to bring back to the committee. We're going to, I think, try about $10 million in
With
loans.
the next loan, what would let's say they got to that point where they paid that loan off, if they got all the way down to 35%, 3 months later, they had a car issue, a medical issue, they need another loan, in this case, 2501 until we do something to change our laws here, where would their interest rate start at that next loan?
So it gets back to, and we fully believe in ability to, and our company and I think many others are going to be going to more banking models. You're going to see bank underwriting occurring at many of these institutions that are going to do this type of lending. You're going to see something akin to credit card underwriting is going to occur for these type of installment loans. You will apply those principles to this space. So assuming that they still qualify for it, if my experience with a consumer is they paid me all the way down to that product, we'll lend to them at 35%. Does every individual qualify for that? No, but for those that do, right now, California has a hole in its law, in its interest rate, that doesn't allow me to lend to them at any kind of rate. Currently it's 18%, I believe. I'm capped at. I can't start a person that I don't know what their credit is like at that rate. So what happens to that consumer right now? They're forced to take out 4 payday loans if they need $1,000. That is what I'm urging you to consider is a product in that range from $500 to $2,500 that would allow me as a for-profit lender to lend profitably in that space, and for the individuals that can earn their way to credit, allow them to do that. So I'll.
You got a minute left.
I got a minute left. Great.
You want to give it back? Do not feel obligated.
I would open. I'm really interested to see what Paul thinks of that idea.
Mr. Leonard, you get it.
I give you a minute of mine, Paul.
Oh, well, thank you.
Anytime.
Well, I haven't seen the piece of paper.
I'll hand it over to him.
I've heard your description.
Yeah.
I'm sure he's got it.
Yeah.
It's the first I've heard of it.
Okay.
I would love to take a look at
We
it.
don't want to put you on the spot, so why don't you take a look at that? We're going to have a little more question and answer. Before I ask you guys, does anyone from the committee want to ask anything of the consumer groups or industry?
Quick question, young lady. You spoke of the sympathizer borrower. Is there any prepayment penalty for those who borrow that are, as you put it, this one lady was educated?
No, go ahead. I'm sorry.
She did not have a prepayment penalty in her loans.
Okay, so when she recognized that she borrowed more than she needed to, could she have paid the rest back?
With the amount of loans that she had, no. She did not have the funds to do that.
But I thought you said she borrowed more than she cared to.
We have had. She was not one of those clients who had said she went to borrow $1,000 and then ended up being into $2,500 loans. That is a complaint from other clients that we've seen, but that particular client, for whatever reason, felt that she needed more money.
But does anybody here has prepayment penalty? No. So they can pay ahead of time and be done.
Ms. Farron, just to follow up on that, because that is a very interesting question from my colleague. Would you say in that your experience and the hundreds, if not thousands, of people you've helped in Orange County, that at least for this sample of individuals who have used these loans, that is not necessarily emergency driven, but, and I'm not trying to make a judgment on this, but so excuse my terminology, this is lifestyle driven. They don't make enough money to pay their bills on a monthly basis for whatever reason, not to pass judgment. They simply just don't have enough money at the end of the month to pay their bills. They need to supplement that. Their way to supplement it out of desperation or choice or whatever you want to use is that they take out these types of loans, and therefore your argument is that there is never an opportunity for these people to pay it back because their individual financial reality is not changing on a month-to-month basis that would give them that income to pay that loan back, and they're just going further and further into debt.
Correct.
Would that be kind of your sense of what this is doing for these populations?
Yeah, the clients that we're working with don't have the chance to build up savings to be able to, to prepay the loans. A lot of them would if they could, but this is the easy solution. It's not always the best solution, obviously, but this is the easy solution because, everyone hears the commercials. Like as everyone said, there's storefronts all over their community. It's the easy way for them to get the money to make up the difference. But what they're having is a long-term income problem.
And we should obviously put the caveat. This is probably not a majority of the people that take out these loans. This is a percentage of that population, very similar to the percentage that we've heard earlier in several different individuals' testimony, that a very large percentage of people, more than I guess, that take out one loan, take out 10. That being said, you've heard our work today. I don't want to pick on you, but I was very interested in your testimony. What do you think as a state we should be allowing these individuals to be offered? Because I will tell you, I won't say I find it offensive. I do find it somewhat laughable that you would tell some of these individuals to go to their family. I think most of these individuals simply do not have an ability to go to their family. And I will tell you, in the surveys I got, not one person said, when we asked what were their alternatives, no one listed, and this is not a scientific survey, and I don't want to mislead anyone on that, no one in the surveys I looked at so far mentioned their family as an alternative. They mentioned credit cards that were maxed out, and they said, I would lose my apartment, I would not be able to fix my car. I mean, listen, I presented two very different scenarios, mostly to set the parameters. Clearly, the student that needed a book that had a kind of a snafu in getting their loan on time is an outlier, much like the educator who had an emergency that fell into a debt trap because then they started using it as a supplement to their income. But there still is a reality that we've heard today. Somewhere between 1 million and 2 million people in our state every year find themselves in need of capital or credit that they can't get from traditional sources. For some reason, a credit card is not an option, family's not an option. And not to put you on the spot too much, and we're going to open this up to more of the panel, and anyone else that spoke that would like to chime in is welcome to either join us or speak from the back mic in our limited amount of time left.